This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the third lecture on inventories. We've done the double entries. I then said the important thing is the valuation of inventories, and in the last lecture I went through the first of the accounting standard rules, that we must value the lower of cost and net realisable value. However, I said that the second problem relates to getting the cost, and the reason it can be a problem is this. You'll wonder why I'm holding these pens, but suppose I buy and sell pens, and during the year I've been buying and selling pens, all year. I buy 100, I sell 50, I buy another 60, I sell 200 and so on. I've been buying and selling pens all year, and at the end of the year I've got 4 pens left, and I need to know how much these 4 pens cost. But the trouble is, I've been buying and selling them all year, and the price has been going up. I bought some at the beginning of the year and they cost $1 each. But then I bought some more a few months later and they were costing $2 each. And by the end of the year, the last lot I bought cost $3. I'm selling them all for $5, so no problem there. The cost is lower. But the trouble is, at the end of the year, is this pen, was that one I bought at the beginning and only cost me $1? Or did it cost me $2? Or did it cost me $3? How much did it cost me? The pens all look the same. Again, the first lot I bought were $1. By the end of the year, they were $3. Is this a $1 pen or is it a $3 pen? How am I going to get the cost? Well, there's where there's a problem. And the accounting standard lists, if you look at the next page, it lists 4 approaches that we can take. Now, in fact, one of them the standard doesn't actually like, as I'll say when we come to. But the first way we can do it is what we call unit cost. Now, no numbers on here for the exam, but effectively what it means is if every unit sort of had the price printed, the cost printed on it, then there'd be no argument. Oh, this one says $1, right, that's $1 one, that one says $3, fine. If it's actually got the cost printed on it, then, we go through and we sort of add them up. But of course, that's unlikely, because if I'm selling these pens at $5, I don't really want the customers to see, I only paid $1 for it. So be aware, if we do know individually what they all cost, no problem. Normally we won't, and therefore it's the second two. Something I've got to explain with example, but we take what we call a first in, first out approach. Which I can't explain in a few words. In a minute, I'll show you by example what that means and how we do it. Or alternatively, an average cost approach. But again, I'll show you that by example. But these are the two where you're bound to be asked one or both of them, but where it does involve calculations. And in a minute, I'll start going through an example explaining. Now, before I do, the fourth way, the accounting standard doesn't actually like. But they do say, if the first 3 ways, if it's just not possible for various reasons, then you can do it the fourth way. But again, they don't like it. Selling price less than estimated profit margin. Now, you won't be asked workings on this. I'll tell you what it means. But if you're a lady and went to a store, a big store, to buy a dress, the dresses all have a price on them. This dress may be $100. This dress may cost $80, and so on. So they've all got a price on them, but of course they're the selling prices. And what the store needs when they're valuing the inventory is the cost. But maybe if I told you that the store overall makes a profit of 40% of selling price, overall of the whole store, they're making a 40% profit, then if we came to one dress and the price marked on it, the selling price, was 100, then what you can do is say, all right, since we make 40% profit, the profit on that dress would be 40, and that would mean the cost was 60. Now, that isn't very good, and as I say, the accounting standard doesn't like it, and that's why you won't be asked arithmetic on it. But if for some reason it's just not possible in real life to do the one of the first three ways, then they will allow you to do the fourth. Anyway, I've already said A and D, you're not asked arithmetic, it's those two we need to go through. And so let me first of all explain first in, first out. I'll do it by example. So if you turn over example 5, have a look with me. It says on the 1st of November, a company held 300 units of finished goods valued at $12 each. During November, we made various purchases. So on the 10th, we bought 400, and they cost us $12.50 each. On the 20th, bought another 400, and they cost us $14. On the 25th, another 400, and they cost us $15. So like I said at the beginning, we're buying units throughout the month, but the cost to us has been increasing. We've been selling units during November, and you've got a list there, sell 500, sell 400. We're selling them all at 20. Remember, we've got to value at the lower of cost and selling price, so cost is lower. But our problem is, any that are left at the end, what is the cost? Did they cost us $15? Did they cost us $14? Or did they cost us $12.50? Well, with first in, first out, we make an assumption. We assume that every time we sell any, we always sell the oldest items first. Think about a supermarket. If you go to buy milk, the supermarket always has the older ones at the front and the newer ones at the back, because they want you to buy the older milk first. And if you think about it, if we always sell the oldest ones first, it means that any left at the end, the closing inventory, are always the newest ones. The closing inventory is always the most recent purchases. Again, think about buying milk in a supermarket. If people do like they want them to, and if you always buy from the front and you buy the old ones, yesterday's milk, then at the end of the day, what are they left with? The ones that are left are always the newest ones. Now, it's an assumption. Obviously, when I'm buying milk, I go to the back and make sure I pick the newest one. But with first in, first out, we assume we always sell the old ones first, and so whatever's left at the end are always the newest ones, the most recent purchases. So let's apply that to this example. First of all, how many are left at the end? At the start, on the 1st of November, the opening inventory, there were 300 units. During the month, we bought a lot, so the purchases, 400, 400, 400. Forget the values for the minute. We bought 1,200 units. But during the month, how many did we sell? Second table, we sold 500, 400, 100. We sold 1,000. And so how many are left at the end? I think 500 units. 300 plus what we bought, less what we sold, with 500 left. And of course our problem is, how are we going to value them? Are they $15, $14, $12.50, whatever? Well, again, our assumption is that if we're always selling the oldest first, the first in and the first out, the 500 left are always the most recent purchases. And so at the end of November, when was the most recent purchase? Look at the list of purchases. The most recent one was on the 25th of November. Oh, now we bought 400. We've got a problem here. We've got 500 left. So they can't all 500 can't have been bought on 25th of November. We assume 400 of them were. So those 400 are all left. The remaining 100, they can't have been bought on 25th of November. They must have been bought the purchase before. So the next latest was the 20th of November. We bought 400. Well, the remaining 100 must have been from there. So you go to the latest purchase. If there aren't enough, you go to the one before, and so on. And so how much did it cost us? Well, on the 25th of November, those 400 cost us $15. Another 100 must have been bought on the 20th of November, and then they were costing $14. And so the total $7,400. And there we are. So first in, first out. I think nice and easy. I mean, as always, be careful. If you'd only 200 left in inventory, fine, they would all have been bought on 20th of November because it was 500, 425th, the rest on the 20th. All right, that's first in, first out. The other way, though, is a little bit more complicated. Average cost. Now that might sound as though it's going to be easy, you know, oh, what was the total cost, and then just work an average. As you'll see as I work through it, it's not quite that easy. There's no quick way here. We have to go step by step. Let's work through it. Same example, but average cost. What we do, we work through in date order. So let's make a start. On the 1st of November, we had 300 units in inventory. They were $12 each. And so the total value, $3,600. No problem. We work through in date order. So keep a check on the dates, but the next thing that happened was on the 10th of November, we buy some more. We bought another 400 units. They cost $12.50 each. And so how much did they cost? 400, $12.50, 5,000. So at that stage, there's no argument. I've got 700 units. The total value, 8,600. And if we stopped, if that was the end of the month, that would be the value. However, the next thing that happens, keep checking the dates, was the 14th of November when we sell some. We sold 500, so we've only 200 left. But this time, instead of saying, oh, those 500, we must have sold the latest ones and so on, we say, well, that we did have 700 units. And in total, they'd cost us 8,600. And so the average cost per unit, 8,600 for 700 units, on average at that stage, it cost us $12.29 per unit. So I did have 700 units at $12.29. And so we say, well, we sold some of them. 200 of those units are still remaining. We'll value them at $12.29. It was 200 of those 700, and so those 200 would have a value of 2,458. Let's carry on. The next thing that happens, that was the 14th, it's the 20th of November. We buy some, we buy another 400, so we've now 600 in inventory. They cost us 14 a unit, a total of 5,600. And so the total value now is 8,058. And again, if that was the end of the month, there is the cost, 8,058, no problem. However, on the 21st of November, we sold some. We sold 400 rather, with 200 left. And the question is, how are we going to value them? Well, those 200 are part of those 600 we had. And those 600, they had a cost of 8,058, so the average cost of those, 8,058 over 600, the average cost, I think 1343. And incidentally, in the exam, do things to the nearest cent. So we had 600 units costing on average 1343 each. We sold some, we've 200 of them left, and so at 1343, they'll be valued at 2686. Now we're nearly there. If you think you're happy with what's happening, perhaps pause the lecture and finish it yourself and then start again and check me. But otherwise, let's finish it off. Next thing, 25th of November, we buy some. Well, buying, no problem. You just add them on. By 400, you have now 600. Those 400 costs 15. 6,000. Total cost 8,686. However, finally, 28th of November, we sold some. And it's when you sell, we need to do these workings. We sell 100 with 500 left, which we all, if you remember, we already knew there were 500 left. But how are we going to value them? Well, they were part of the 600 we had, which had a value of 8,686. So the average cost of those was now 8686 divided by 600. 1448. And therefore, at 1448 each, there are 500 of them left. And at 1448, they'll be valued at 7,240. Oh, 7,240. And there we are. So it obviously is that bit messier. And check very carefully. If you're asked one of these type questions, it may sound silly, but I've seen so many times it says we use FIFO, and people go and do weighted the average cost, or it says we use average cost and they go and do FIFO. That's just silly. Check which they want. You're likely to be tested on both of them, not in the same question, but on both of them. FIFO should be very quick. Average cost, they tend to keep the questions fairly short, but even so, that's obviously going to take longer. A couple of things where I'll leave this. One is that the two methods clearly do give different answers. Using average cost was 7,240, whereas using FIFO, the value, I just looked and I forgot already, 7,400. Well, no problem. I mean, you will obviously stand to give different answers, but getting different values for inventory will affect the profit. Think about it. Think about what we were doing in the very first lecture on inventories. But just let me make up some figures before I go back to that. Suppose I told you sales were 15,000. Suppose I told you purchases were 12,000 and there was closing inventory of 2,000. I'll go back to our figures in a minute, but nothing new there. Suppose, though, we valued inventory different and got a higher figure. Just suppose the value of inventory was 2,500. What would happen to the profit? It would mean the cost of sales fell to 9,500 and the profit went up to 5,500. Now, the reason I mention that, the two different methods of valuing inventory will give different values and therefore will give different profits. And do be clear, because this could be asked all on its own, higher closing inventory will mean higher profit. And so in this case, valuing using the average method would be a lower profit. Valuing using FIFO would give a higher profit. Now, because of that, the accounting standard says, although do it either way, you must do it the same way each year. Because if you think about it, all right, if the closing inventory is 7,400, higher closing inventory, you have higher opening inventory, and that would act the other way around. So in the long term, it doesn't make any difference, provided you use the same method each year. You can't each year say, oh, which one looks better, you know, you can't keep changing. Okay, so there we are, they're the two methods. Otherwise, I'm afraid that's just practice. I have one final, maybe a very short lecture. The next one, where just say a little bit more about the Candy Stand number 2. but no arithmetic.